Let's say, hey, KP, you told me to get into a house, but man, the rates are still at 7%. It's been a year since I watched your first video. Dude, this rate's killing me. When are they coming down? There is something that you can do that you can ask your loan originator. Hey, it's KP coming to you live from Corona, California. And this is our first episode in a series as we explore financial literacy together. I've been in housing for about 21 years on the mortgage lending side. I'm one of the owners of a 2,300 employee company called Paramount Residential Mortgage Group, and I've got a real unique perspective on managing mortgages, housing, your assets, money, what's going on in the macroeconomic view, and just all things in general, trying to find financial freedom for generations to come. So let's get started. What's going on today in the macroeconomic view? Housing has come down quite a bit from its peak over the last couple years. So here we are in October, in fall of 22, some uncertainty about our economy. Are we in a recession? Are we going into a recession? I leave those for the economists who are right about as often as weathermen. Unfortunately though, the way those macroeconomic trends play out, they affect you and I's pocketbook and how we think about whether it's right to buy a house or to invest in the stock market, start saving or go look for another job or have another child. The Fed right now, they have been raising the federal funds rate, and that has been having an impact on interest rates for car loans, home loans, student loans, everything. When money gets more expensive, it does impact everything that we do, and it's not something that we can control. How does that impact you and your pocketbook? Well, one good thing is buying a home. Are you a homeowner? I'm here as an advocate for home ownership. I am a huge fan of anyone at any time trying to make sure that they get into a house as soon as they can. I know that rates are up. I know that houses are expensive. It may even sound self-serving, but taking off my lender hat and being your trusted advisor, I think getting into a home is the single greatest way to create net worth and wealth for you and your family for generations to come. The reason why owning a home is such an integral part of our net worth is because it also comes together with a very basic need, which is shelter. We all need a roof over our head. So hopefully for you and your family, you're able to get a roof that gives you equity, that appreciates in value. It's a forced savings plan. So even though the Fed right now is raising interest rates at about 75 basis points per meeting, as we see these numbers go up and the Fed raise interest rates, it may scare people into getting a new car, taking out more debt, or buying a home. But if you're taking a long view with your house and your decision to buy a house, again, it is shelter and rent is going up as well. Again, as a huge advocate for home ownership, I think that even with rates being as high as they are now, let's just say on average they're around the 7% range, it's still a good time to buy, because whenever you take out that loan, your monthly mortgage payment will continue to chip away at that loan balance and you'll gain equity over time. Historically, over the last 30 years, which includes the Great Recession of '08, home prices have appreciated about 4.5% a year. So you're getting appreciation from that asset, in addition to you chipping away at the balance of your loan, and it ends up being a net win for homeowners. And again, if the alternative is you're renting, rent has been going up as well. So there's things to consider. Look, we buy and sell money. People don't think about the mortgage industry or housing as an asset as much as they maybe think about it as shelter. But I want to kind of open your eyes to some things. So lenders, what we end up doing is we end up taking your loan when we close and fund on it, and we put them in securities. They're called mortgage-backed securities, MBS. And these mortgage-backed securities are seen as a safe haven for investors. Most people that take out a mortgage pay it, and they pay it on time. And the quality of loans since '08 and that Great Recession, which was a credit crisis, the quality of loans since Dodd-Frank Act was passed have been the highest quality ever. So those mortgage-backed securities, those MBS, are backed with buyers that by and large make their housing payment. That stream of income, that monthly payment coming in, will then pay the mortgage-backed security, the bondholders, and pay them a solid stream of income. And that is why mortgage-backed securities are seen as a very safe haven fixed income asset. The Fed, when they buy and manipulate the money supply, they're buying treasuries and they're buying mortgage-backed securities. And then they sell treasuries and they sell mortgage-backed securities. In addition to holding the Fed funds rate at a certain level to tame unemployment and inflation. So those are the macro factors that we deal with every day. And I'm going to give you a visual to kind of rein this in here. So here, for example, you can see this thing is updating live as we look. You can see what's going on with treasuries. So a 10-year treasury is, seen as a pretty good barometer of what goes on with the mortgage interest rate. It's not a direct correlation, but it's a general correlation. Most people stay in their mortgage for an average of 6.5 to 8.5 years, which is about the same duration as a 10-year treasury. Just a general trend here, you can see since August, the rates have been going up. And as rates go up, 10-year treasuries, the yield goes up, the price of the treasury goes down. There's this inverse relationship between yield and price. The 10-year treasury yield has gone up above what's been seen as a pretty historic line of demarcation, the 4% line. It's been kind of hovering around that line. This service will show you mortgage-backed securities have been touching around this 10-year treasuries, this 4% yield, and rates have kind of hit this little area where, okay, this is the highest rates have been in a few years. What are they going to do next? One of the themes I'll talk about in these videos is uncertainty. People like certainty. They want to know, are rates going down? Are they going up? Obviously, no one really knows. No one has a crystal ball. But we can look at trends, we can look at data, and we can look at patterns, and we can take our best guess. At the end of the day, if you need a roof over your head, rent's going up, rates are going up, does it really matter long term? If you need to buy a house, if you need to get into a home, does it really matter? Because again, at the end of the day, you're already paying for shelter. Here's one thing, I'll give you a little hot take. The prevailing wisdom for interest rates based on what's been going on in the market is that they, if are not at their peak, they are certainly very close. And a lot of big institutional traders feel that sometime next year, the Federal Reserve will have to pause on all the rate hikes that they're doing. And when they do that, mortgage-backed securities and 10-year treasuries may also peak out. Now, again, I don't have a crystal ball, but a lot of people think that if you do a loan today in this, say, 7% range, which is the going rate, that you will have a very good opportunity to to do a refinance next year. So that's something you have to think about when you're formulating your thoughts on whether to buy a home. I can tell you all the data that I've seen, you start to see a lot more purchases happen coming in the spring. So right now, here in the fall, heading into the winter, it does seasonally slow down. But the data is showing that people are lurking and looking, and they're trying to find a house online using whatever data source that they may have. And I'll add one more thing that's coming together here. The housing supply, it's very limited. There are not a lot of homes for sale in many, many markets. Supply and demand is something that impacts home prices. Will home prices come down? They seem to have peaked in about March to May of 2022, of this year. And so home prices have had a historic rise because there was so much cheap money injected into the system by the Federal Reserve, by the Fed leaving rates down at historically low rates, basically at zero money rates. The 10-year treasury coming down, this chart we're looking at. Mortgages being in the 2.75%, 30-year fixed range. I mean, this money was so cheap. It made it more affordable on a monthly payment to get into houses. So you saw people buying and buying crazy. Now that money is a little more expensive, rates are a little more high, housing supply is still short, but you still might see a little bit of home price depreciation next year. But everyone is saying, with this conventional wisdom, I'm gonna wait to see how much lower home prices get, or maybe do rates come back down. Everyone's thinking that. So do you want to get in front of them? Because if you find that house that you like, you might want to lock it down because it might not be available come the spring purchase season. Before the Great Recession in 2008, home builders were building, let's just say, about 20 million units a decade. That number has come down significantly. I'll tell you why. Home builders who are responsible for creating more supply were not bailed out by the US government like the banks were bailed out. So the money center banks were given money, and the Treasury, the US Treasury Department, bailed them out. But builders were not bailed out. So there was tons of consolidation. And now in 2022, there are two fantastically run companies, D.R. Horton, the largest home builder in America, and Lennar, the second largest, who are responsible for 53.5% of all single family residences built. Two companies are responsible for more than half of all housing supply that's out there. Think about the kind of landscape that sets up for builders to have to protect themselves in the way they operate and do business. You know, these builders will go find land in outskirts of town, buy vacant land, permit it, fix it up, get it in shape to be able to have housing product put out there. And it could take them years before they even break ground on the houses. To think about having that much capital and have that much foresight to go out and build that product, it's no wonder that there are a lot less builders out there, and thus a lot less housing supply. So when the seasonal trend comes back around in the spring and people just go out looking for homes, in your market, there might not be enough homes for sale to meet the demand again. Even though seasonally right now, in the fall and the winter, it may not appear that way, especially coupled together with higher interest rates. Obviously, the alternative is renting. There have been a lot of multifamily starts, housing starts. This is a data point that I look at. So that means more apartments being built, which at some point, let's say 6 months from now, rent might start to actually come down. Again, it's market specific. Some markets build more and faster than others. Some markets have more population coming in. So something to think about where you live and what's going on with those macro factors. Again, I think it's always the right time to buy if you've never owned a home. Not for any other reason than you're already paying rent. You're already paying this huge monthly payment. I'm gonna talk about one more thing that could help you manage your money, and I'm gonna talk about a 2-1 buy down. And it is something that a lot of people don't know about, and it's a way to mitigate the risk of higher interest rates that are out there. Let's say, hey, KP, you told me to get into a house, but man, the rates are still at 7%. It's been a year since I watched your first video. Dude, this rate's killing me. When are they coming down? There is something that you can do that you can ask your loan originator. You can ask them about a 2-1 buy down. I'll give you an example of what that is. If you buy down the rate, let's say the interest rates right now are 7%. You can, for the first 2 years, buy down that rate for 2% less than the 7% going rate. That means for the first year, you would have a payment at 5%. So a little bit lower mortgage payment. In the second year is a 1% buy down. 5% for the first year, 6% interest rate for the second year, and then at the beginning of that third year, you would have a 7% rate. Now the conventional wisdom is that interest rates will be below where they are now within the next 2 years. With a 2-1 buy down, you can lock in today's rate, have a lower payment for the first 2 years, and if you can negotiate, the seller can pay for that fee that buys down the rate. Sellers out there right now are noticing that there are less buyers because housing has gone into a recession with higher rates. But if a seller wants to move along, they might be willing to negotiate and pay for your 2-1 buy down fee out of the proceeds of their record equity they've gained over the last couple of years and help you with a lower monthly payment, help them get out of the house without bringing down the price of the home, actually rolling that cost into that price and giving you a seller concession to pay for a lower rate. It's a 2-1 buy down. Remember, 75% of all sellers of homes go buy another home. They're looking at the same problems you are. Rates are high, prices are higher than they were, but if you gotta move, you gotta move. So are sellers listing, are they motivated as well? It's something to think about when you're out there looking at homes and trying to put shelter over your head, especially as a first-time home buyer. So hopefully these tricks have been helpful for you. I'll kind of leave you with some more macro information here. The Fed is looking at inflation. Inflation is a number that comes out with several different data indicators, right? Probably some of the main ones are the Consumer Price Index, known as the CPI, the PPI, which is the Producer Price Index. Those are pieces of data that come out once a month. Consumer Price Index is pretty important. What do you and I as consumers, what do we pay for goods and services? There are a couple different CPI components out there. You hear of CPI, then core CPI, which excludes food and energy. You and I don't exclude food and energy. We got to eat every day. We got to keep the AC or heat on. But CPI is a measure that the Fed and many economists look at when they want to see, is inflation still rising? The most recent September CPI number said that inflation is still pretty high. And if you look at the core reading, which takes out food and energy is very volatile, right? They can go up or down very quickly, which is good and bad. Gas prices at the pump could get high or they could go low very quickly. A lot of it has to do with our domestic energy policy by whoever is within the administration, what's going on with a war between Russia and Ukraine, or any other macro factors like OPEC. Those are things that we don't control and they're very volatile. Same thing with food. You know, the Fed can raise the federal funds rates, but they can't pump more oil. They can't refine more gas or find more natural gas. So those CPI readings, they tend to exclude, and we say the core reading will exclude food and energy. Now, in the core, which was still going up in the last month, one of the biggest components is rent or owner's equivalent rent. If I were to rent instead of own a home, what would my equivalent price be? Now, that's data coming in. It's typically about a 6-month lag with the data coming in for rent information. But people are renewing their rents and their rents are being raised, and there's a lot less vacancies for rent out there. And rent continues to go up. So when that CPI number comes out and shows rent still going up, it makes a strong case for you to continue to look at buying a home as opposed to being a renter. We're gonna watch this data daily as it comes out. That CPI number comes out monthly. There's a PPI number, which is the producer price index. That's like input cost for producers that build goods. You know, does it cost more money for lithium to create batteries? There's so many different things that go into the producer price index. And so that's a number that we'll watch to see if inflation is being tamed by the Fed. And you and I have access to a lot of the data that comes out publicly that they're using to decide whether inflation has rolled over and has started to come down, or whether it's going to remain elevated and for how long. Now, we don't have all the information and data that the Federal Reserve and US Treasury has, but we do get a chance to see and hear them speak about what they're looking at. We're going to talk more about dollars and cents and using your common sense and trying to find ways to make you a better money manager, a homeowner, things to do with your home, to upgrade it and repair it. We're going to help you create generational wealth, and we are going to try our hardest together to learn and obtain financial freedom. Thanks for listening for this first episode today. Cheers.